Hello, here is Amy. Welcome to the third session of the Account Double Any Trouble. Thank you for tuning in today. I've divided my presentation into three parts. They are: the double entry accounting system, rules for debit and credit for transactions that affect assets, liabilities and owner's capital, rules for debit and credit for transactions that affect revenue, expenses and withdrawals. You will learn how to describe the characteristics of an account and a chart of accounts. You find out how to use T accounts to illustrate the rules of debit and credit for asset accounts, liability accounts, and the owner's capital account, and how to express the accounting equation. You will learn how to use T accounts to analyze transactions that affect assets, liabilities, and the owner's capital account. And finally, you find out how to analyze transactions into debit and credit parts. Key terms in this session are: chart of accounts, credit and debit, double entry, accounting, ledger, normal balance, T account. Let's start with double entry accounting system. The chart of accounts. Now I'd like to move on to T account. Accounting systems are designed to show the increases and decreases in each accounting equation element as a separate record. This record is called an account. An account, in its simplest form, has three parts. A title, which is the name of the accounting equation element recorded in the account. A space for recording increases and decreases in the amount of the element. The account form presented here is called a T account because it resembles the letter T. The left side of the account is called the debit side, and the right side is called the credit side. A debit is an entry on the left side of an account. A credit is an entry on the right side of an account. This system is more efficient than updating the accounting equation for each transaction. The T account is a simple way to illustrate the effects of transactions on accounts and financial statements. For this reason, T accounts are often used in business to explain transactions. Chart of accounts. How is the chart of accounts organized? A chart of accounts is a list of all accounts used by a business. A small business may require only 20 or 30 accounts, but a large one may have several thousand. Recall that an account is a record of changes and balances of a specific asset, liability, or component of owner's equity. Accounts may have different physical forms, depending on the system. In a manual system, each account may be a separate page in a book or a separate card in a tray. In an electronic system, accounts are stored on disks or hard drives. Whether a system is manual or electronic, accounts are grouped together in a ledger. The ledger is often referred to as the general ledger. Keeping the books refers to maintaining accounts in the ledger. Information is taken from the ledger and organized into financial statements. A system for numbering accounts makes it easy to locate individual accounts in the ledger. Account numbers have 2 or more digits used for sorting information based on the kinds of reports the business needs. A small company may use a 3-digit system. A very large corporation may use 35 or more digits. The accounts are normally listed in the order in which they appear in the financial statements. A typical numbering system used to prepare a chart of accounts is as follows. Asset accounts begin with 1. Liability accounts begin with 2. Owner's equity accounts begin with 3. Revenue accounts begin with 4. Expense accounts begin with 5 and 6. The balance sheet accounts are listed first, in the order of assets, liabilities, and owner's equity. The income statement accounts are then listed in the order of revenues and expenses. Next, I'd like to take a look at assets, liabilities, and owner's equity. Do you remember? Assets are resources owned by the business entity. These resources can be physical items, such as cash and supplies, or intangibles that have value. Examples of intangible assets include patent rights, copyrights, and trademarks. Examples of other assets include accounts receivable, prepaid expenses, such as insurance, buildings, equipment, and land. Liabilities are debts owed to outsiders, Creditors. Liabilities are often identified on the balance sheet by titles that include the word payable. Examples of liabilities include accounts payable, notes payable, and wages payable. Cash received before services are delivered creates a liability to perform the services. These future service commitments are called unearned revenues. Examples of unearned revenues are magazine subscriptions received by a publisher and tuition received by a college at the beginning of a term. Owner's equity is the owner's right to the assets of the business after all liabilities have been paid. For a proprietorship, the owner's equity is represented by the balance of the owner's capital account. A drawing account represents the amount of withdrawals made by the owner. Revenues and expenses. Revenues are increases in owner's equity as a result of selling services or products to customers. Examples of revenues include fees earned, fares earned, commissions revenue, and rent revenue. Expenses are result from using up assets or consuming services in the process of generating revenues. Examples of expenses include wages expense, rent expense, utilities expense, supplies expense, and miscellaneous expense. Now I'd like to move on to rules for the transactions that affect assets, liabilities, and owner's capital. Applying credit and debit rules for business transactions. All businesses use what is called the double-entry accounting system. This system is based on the accounting equation and requires that every business transaction be recorded in at least two accounts. In addition, it requires that the total debits recorded for each transaction equal the total credits recorded. The double-entry accounting system also has specific rules of debit and credit for recording transactions in the accounts. Debits and credits are used to record the increase or decrease in each account affected by a business transaction. Under double-entry accounting, for each debit entry made in one account, a credit of an equal amount must be made in another account. Debit and credit rules vary according to whether an account is classified as an asset, a liability, or the owner's capital account. Regardless of the type of account, however, the left side of an account is always the debit side and the right side is always the credit side. Each account classification has a specific side that is its normal balance side. An account's normal balance is always on the side used to record increases to the account. The word normal used here means usual. That brings us to rules for asset accounts. For asset accounts, the increase side is the debit. It is the left side of the T account. The decrease side is the credit, it is the right side of the T account. Notice the plus and minus signs that are used to indicate the increase and decrease sides of the account. They do not mean the same thing as debit and credit. Since the increase side of an asset account is always the debit side, asset accounts have a normal debit balance. The normal balance side is shaded in the following T account. For example, in the normal course of business, total increases to assets are larger than or exceed total decreases. You would expect an asset account, then, to have a normal debit balance. Let's apply these rules to an actual asset account. Look at the entries in the T account for cash and bank shown here. The increases in the account are recorded on the left, or debit side. The decreases in the account are recorded on the right, or credit side. Total debits equal $350, $200 plus $150. Total credits equal $110, $70 plus $40. To find the balance, subtract total credits from total debits, $350 minus $110. The debit balance is $240. Rules for liability accounts. The rules of debit and credit for liability are: liability accounts are increased on the credit, it is right side. Liability accounts are decreased on the debit, it is left side. The normal balance for liability is the increase, or the credit side. Let's apply these rules to actual accounts. Look at the entries in the T account here for the liability account. Accounts payable. Increases are recorded on the right, or credit side. The decreases are recorded on the left, or debit side. Total credits equal $375, $200 plus $175. Total debits equal $175, $100 plus $75. To find the balance, subtract the total debits from the total credits, $375 minus $175. The credit balance is $200. Now look at the entries in the T account for the owner's equity account. Remember that the rules of debit and credit for the capital account are the same as those for a liability account. Increases to owner's capital are recorded on the right, or credit side of the account. Decreases are recorded on the left or debit side. The capital account has a normal credit balance. If you subtract the total debits from the total credits, $4,000 minus $550, you have a credit balance of $3,450. Moving on to the next section, let's take a look at analyzing business transactions. How do you analyze transactions? When analyzing business transactions, you should use the following step-by-step method. First step, identify and classify the accounts affected. Second step, determine the amount of increase or decrease for each account affected. Third step, which account is debited and credited? For what amount? Fourth step, what is the complete entry in T account form? Right. Now, let's move on to first business transaction. James Clark took $30,000 from personal savings and deposited that amount to open a business checking account in the name of Delivery Service. The accounts, Cash in Bank, and James Clark Capital are affected. Cash in Bank is an asset account. James Clark Capital is an owner's capital account. Cash in Bank is increased by $30,000. James Clark Capital is increased by $30,000. Increases in asset accounts are recorded as debits. Debit Cash in Bank, for $30,000. Increases in the owner's capital account are recorded as credits. James Clark Capital, for $30,000. Business Transaction 2. Delivery Service bought a used truck, on account, from North Shore Auto, for $15,000. The accounts delivery equipment and accounts payable North Shore Auto are affected. Delivery equipment is an asset account. Accounts payable North Shore Auto is a liability account. Delivery equipment is increased by $15,000. Accounts payable North Shore Auto is increased by $15,000. Increases in asset accounts are recorded as debits. Debit delivery equipment, for $15,000. Increases in liability accounts are recorded as credits. Credit, accounts payable North Shore Auto, for $15,000. Right. Now, let's move on to third business transaction. Delivery Service issued check for $2,000 to buy a computer system. The accounts computer equipment and cash in bank are affected. Computer equipment and cash in bank are asset accounts. Computer equipment is increased by $2,000. Cash in bank is decreased by $2,000. Increases in asset accounts are recorded as debits. Debit computer equipment, for $2,000. Decreases in asset accounts are recorded as credits. Credit cash in bank, for $2,000. Business Transaction 4. Delivery Service mailed check for $300 as the first installment payment on the truck, purchased from North Shore Auto. The accounts, account payable North Shore Auto, and cash in bank, are affected. Accounts payable North Shore Auto is a liability account. Cash in bank is an asset account. Accounts payable North Shore Auto is decreased by $300. Cash in bank is decreased by $300. Decreases in liability accounts are recorded as debits. Debit accounts payable North Shore Auto for $300. Decreases in asset accounts are recorded as credits. Credit cash in bank for $300. Business Transaction 5. This would be where one type of liability is exchanged for another liability. The delivery service has accounts payable that are due for $4,000. Since they are short of cash, the firm agrees with one supplier that the firm receives an extension of 2 months, with 5% annual interest. The invoice now needs to be categorized as a note payable. The accounts payable and notes payable are affected. Accounts payable is a liability account. Notes payable is a liability account. Accounts payable is decreased. Notes payable is increased. Decreases in liability accounts are recorded as debits for $4,000. Debit, accounts payable Blue Company. Increases in liability accounts are recorded as credits for $4,000. Credit, notes payable, Blue Company. Rules of debit and credit for transactions that affect revenue, expenses and withdrawals.